Welcome to the deep dive. Today we're digging into a fascinating source. It's a YouTube live stream from the V Investment Academy. And it tackles a really big question, one that I think many of you might be asking right now. In these times of global uncertainty, where market crisis even, where can you find quality assets? The source specifically zeroes in on Thai stocks, looking for opportunities using a particular analytical approach.
Yeah, think of this deep dive as a guide, really, helping you understand one specific framework they use for evaluating potential opportunities when prices are falling. It helps cut through some of the noise, We're going to pull out the key insights, look at the broader economic picture they describe, and then really explore their step-by-step process for hunting down potential value.
Okay, great. So let's start by setting the scene. What's the turbulent backdrop the source is painting here? It sounds like uncertainty is the word, globally and in Thailand.
Absolutely. Globally, the source really highlights escalating trade tensions. And it's not just, the usual US-China stuff we hear about all the time. They also mention potential new fronts opening up, like possible US tariffs on European steel. That kind of thing sends ripples everywhere.
Right, adds another layer. And on top of trade, there are geopolitical tensions, proxy wars. It sounds like a pretty unstable mix.
It really is.
Yeah.
And it makes economic decisions feel very tangled up with political risk. Plus, we're seeing some, let's say, concerning economic data points. The source specifically mentioned weak manufacturing numbers out of China recently. Their PMI, the Purchasing Managers Index, dropped below 50.
And below 50 is the contraction signal, right?
Exactly. It suggests manufacturing activity is shrinking, which is often seen as a potential flag for a broader global slowdown.
Okay, so that's the global view. Now, bringing it home to Thailand, the source says the political situation adds another layer of complexity.
Yeah, political instability here makes it tough to effectively implement needed economic policies, and that naturally impacts investor confidence.
Makes sense.
And they even mentioned some localized issues with neighbors. I think one specific example was with Cambodia, just adding to that sort of regional risk picture.
Now, here's something this source said that really caught my attention. They view the Thai stock market as having been a leading indicator, meaning while other global markets are maybe just starting to wobble now, the Thai market, according to them, has already been heading down for 2, maybe 3 years.
That's a key perspective they offered. It suggests, maybe others are just entering year one of a potential downturn, while Thailand might already be further along that path.
So you combine the global friction, the domestic challenges, the geopolitics, and the source describes this climate as one of increasing distrust.
Yeah, they actually framed it as a new kind of war, this war of distrust among countries, among investors. It's a strong framing.
And that distrust, that fundamental uncertainty, is what they argue is driving money towards safe haven assets.
Precisely. They pointed to gold continuing its rise, which apparently validated a view they'd shared the week before. It fits that narrative of flight to safety.
Okay, so that's the broad picture. Now, you mentioned a specific, maybe even unique concern the source raised about sovereign debt, focusing on Japan.
Yes, this was really interesting. Japan's public debt to GDP ratio is, huge. The source flagged it as the highest among developed nations, over 200%. Now, historically, people didn't worry too much because most of it was held domestically. Japanese savers, institutions, almost like borrowing from yourself.
Right, kept it internal. But the source sees a change now.
They do. They highlighted rising yields on Japanese government bonds. The example given was the 30-year bond yield clinging from almost 0% up to 3%.
And rising yields mean falling bond prices, right? People selling.
Exactly. When yields go up, prices go down. It means there's selling pressure. And that raises questions about liquidity in Japan's own bond market. Could it become harder or more expensive for the Japanese government to issue new debt down the line?
Okay, so domestic pressure building. How does that connect globally? Japan's a huge holder of U.S. debt, isn't it?
The largest foreign holder, yeah. Holding about $1.1 trillion in U.S. Treasury bonds. The source put that in context, mentioning Japan's total public debt is around $8.7 trillion, U.S. total debt around $36 trillion. So that $1.1 trillion held by Japan is a significant chunk of foreign ownership.
So the big question the source is posing is, if Japan faces enough pressure at home, might they need to sell some of those U.S. treasuries?
That's the potential scenario they sketched out. Could they be forced to sell U.S. bonds to raise cash or stabilize things domestically?
And the ripple effect. If Japan, the biggest foreign buyer, starts selling, what happens then?
Well, what do other big holders do? Like China, who the source noted have been less keen buyers recently anyway, European countries.
Could it trigger wider selling?
The source definitely sees this potential selling pressure as part of that war of distrust spilling over, affecting even assets usually seen as super safe, like U.S. Treasuries. It's a fascinating angle on how global tensions could play out in finance.
Wow. And just for our listeners' awareness, the source mentioned even Thailand holds a decent amount of U.S. Treasuries, about $48 billion. Something to keep in the back of your mind.
Yeah, good context.
Okay, let's completely shift gears now. Back to the Thai stock market. The source didn't just paint a gloomy picture. They offered a specific way to look for potential opportunities, right?
Exactly. Their core mission, as presented, is trying to find companies whose stock prices might have fallen below their, let's say, intrinsic value. Not because the business itself is broken, but because general market fear has dragged everything down.
Important distinction. And they stressed this is a case study, a demonstration of method, not specific buy-sell advice.
Correct. Very important disclaimer. They mostly focused on larger companies, the SET50 index constituents. The thinking there is that bigger firms are generally more likely to weather major crises, and if their prices get hit hard enough, they might offer significant value potential, though they did include a couple of smaller company examples too.
So how did they actually sift through these companies? What's the process?
It was a pretty clear three-step filtering process they outlined.
Okay, step one.
Step one, look for companies in the SET50 that hit a new high in net profit per share, either in 2023 or 2024. That's the first hurdle. The goal is to find companies showing strong recovery or performance recently, despite the headwinds. Resilience in core profit, post-COVID, basically.
Got it. So who passed that first test from the SC50, according to the source?
Let's see. The list included BDMS, BH, CPEL, CPN, HomePro, Asian Property, that's AP, Plan B, PTT, Tisco, BBL, KBank, and KTB. And the two non-CT50 examples that also passed were TF, which is Thai Food Group, and Sabina.
What struck me was their comment that more than half of the SC50 didn't pass this first step.
That really says something, doesn't it? It shows just how tough the profit environment has been. Even for Thailand's biggest companies, many haven't clawed back to their previous profit peaks yet.
Yeah, quite telling. Okay, so after finding companies with strong recent profits, what's step two?
Step two is about competitive strength, looked at through gross profit margin stability, GPM. They look for companies that manage to keep their GPM relatively stable during past crises, like the 2019-2020 COVID period.
And why is GPM stability the key metric here? What does it show?
The source sees it as a test of competitive advantage or pricing power. If your GPM stays stable in a crisis, it suggests you didn't have to desperately slash prices just to make sales. Your product or service probably has enough differentiation or brand strength that you could maintain your profit margin per unit even if overall sales volume dipped. It points to resilience.
Okay, that makes sense. It's about the quality of the sales, the profitability margin. So who passed this GPM test from the step one list?
The list got shorter. Passing step two were BDMS, CPL, CPN, HomePro, Asian Property, AP, and WH, which is WHA Corporation.
And who got filtered out here? Companies that had the profit recovery but maybe not the margin stability?
Right. They mentioned filtering out companies like Ikitan, Plan B, PTTP, and Siri at this stage because their GPM showed more significant drops or volatility during past tough times. They use a specific comparison. AP's GPM only dropped about 1% in a crisis, while Siri's dropped maybe 10%. That highlights, by this metric anyway, AP's relatively stronger competitive position according to the source's framework.
Yeah, that comparison makes the concept really clear. Okay, so new high profit, check. Stable GPM, check. What's the final hurdle, step three?
Step three is valuation, specifically looking at the remaining company's price to book value, or PBV, relative to their return on equity, ROE.
Okay, let's quickly define those. ROE is?
How effectively the company uses shareholder equity to generate profit. Higher ROE, more profit bang for the equity buck.
And PVV?
Compares the stock price to the company's net asset value on paper, its book value per share.
And the source says these two are usually connected.
Highly correlated, yeah. They mention like 80–90% correlation often seen in Thai and global markets. Generally, higher ROE companies command higher PBV multiples because, well, their higher profitability justifies it.
So the analysis in step three isn't just looking at current PDV in isolation. It's comparing current PBV to current ROE, but in the context of the company's own history.
Exactly. They plot the historical relationship, how PBV typically tracked ROE for that specific company. Then they look at the current ROE, from the Step 1 profit figure and the current PBV as of late May 2025 when the source did this. The goal is to spot if the current PBV looks significantly lower than what the company's historical pattern suggests it should be, given its current level of profitability.
Looking for a disconnect, where the market price seems overly pessimistic compared to the underlying profit generation.
Precisely. That potential disconnect is what they frame as a margin of safety, finding stocks that might be cheap relative to their fundamental earnings power based on their own track record.
Got it. That's a clear framework.
Huh.
So let's run through some of the companies that made it to Step 3. How do they stack up in this valuation check, according to the source?
Okay, well, BDMS and BH, the hospital stocks, were both seen as potentially having a margin of safety. BDMS was around 3.28x PBV, BH around 3.98x, both trading below where their historical PBV ROE relationship might indicate, especially BH, which was noted as well below its past highs.
CPL, the 7-Eleven operator.
Also seen as potentially having a margin of safety. PBV around 3.17x, fitting that pattern of being potentially undervalued relative to ROE based on its history.
And CPN, the ball developer.
Yeah.
You mentioned something about their land value earlier.
Yeah, CPN really stood out in their analysis, trading around 2.0x PBV, which they saw as significantly below its historical norm for its current ROE. And they specifically mentioned that book value, especially for land CPN has held for a long time, uses historical cost, not current market value.
So the actual asset value might be much higher than what's on the books.
Potentially, yes, which makes the PBV ratio look even lower, contributing to that perceived deep margin of safety.
HomePro, the home improvement store.
PBV around 3.57x, also flagged as having a relatively high margin of safety, combining that valuation picture with its strong, stable GPM from Step 2.
Asian property AP. Very low PBV, you said.
Extremely low, yeah. Around 0.48x PBV. Looked very cheap on that metric, and they noted a strong dividend yield too, like 7-8%. But the source added the caveat, you need to be comfortable with the property sector itself.
Right, sector risk. What about WH Corporation? Industrial estates.
WH was around 1.3x PBV. They mentioned it actually looked expensive maybe late last year, but the price had dropped quite a bit. So now it was seen as potentially offering a margin of safety, particularly attractive if you're interested in that logistics industrial space.
Okay, let's talk banks. BBL, KBank, KTB, Tisco. How do they look through this lens?
BBL, at about 0.49x PBV, was singled out as perhaps the cheapest among the big banks, offering the most margin of safety within that group based on this framework. KBank, interestingly, was seen as not cheap right now. Its PBV had apparently risen recently. The advice from the source was maybe look for a lower PBV, closer to 0.5x maybe.
Okay.
KTB, around 0.69x PBV, was deemed sort of fair. Not particularly cheap, not expensive. And Tisco, much higher PBV around 1.75x, was considered expensive by this method. The thinking was its price might be driven more by its reputation as a high dividend payer rather than its fundamental value relative to ROE.
Interesting nuances there. What about the two non-SET50 examples, Sabina and TF?
Sabina, the lingerie company, TBV around 2.9x. Price had dropped, seen as having a decent margin of safety. They highlighted positives like no debt, stable GPM, good dividend. TF, Thai Food Group, PBV around 1.8x. Also had a price drop, also seen as potentially having a margin of safety.
And just to close the loop, the companies filtered out earlier, CRI, Ichitan, Plan B, PTTJP, why did they remain less attractive even if some had low PBVs?
Right, so Sarah, even with a low PBV near APs around 0.47x, was viewed as not cheap when considering its 2024 ROE and, crucially, its less stable GPM history compared to AP. So AP still looked like the better bet for property exposure within this framework. Ichitan, PBV 2.21x, and Plan B, low PBV, just weren't considered cheap enough to offer the desired margin of safety. Plus, the GPM volatility was a red flag for the source. And PTCP in energy has inherent sector volatility, and the GPM wasn't stable enough, making it less suitable for this particular value hunting method, regardless of its PBV.
Okay, that covers the core three-step analysis really well. But the source also fielded questions on other stocks and topics during their live stream.
Yeah, they did. There are quite a few questions from the audience they addressed.
Like hotel stocks, Centel, Mint.
Yep. Common question. The source said they simply didn't pass the initial screens. Profit wasn't a new high. GPM wasn't stable. Their view was both might actually fall further. The advice was basically wait for potentially much lower prices, citing maybe below 20 baht for Centel as an example entry point to consider later.
They also mentioned their own DCA portfolio.
They did, the pay DCA portfolio. They noted it was holding up relatively well, lost less than 20%, including dividends, which was apparently better than the overall market. For people thinking about starting dollar cost averaging, the message was basically jump into their existing model portfolio, paper DCA one. Now, don't try to perfectly time the bottom.
What about managing existing gains, say in the S&P 500?
Good question came up. The advice wasn't sell everything now to time a dip, more like use annual rebalancing. If the S&P 500 has run up so much that stocks are now overweight in your overall portfolio beyond your target risk level, turn back to your target allocation. Discipline rebalancing, not market timing.
Sensible. Any views on other markets? Japan again. Bonds.
On Japan, they repeated the view. Weak yen is good for tourism, but expect Japanese stocks to keep falling. For parking cash during uncertainty, they seemed positive on Thai bond funds, especially ESG-focused ones. They explained the recent strong returns, like 7–8% over 1.5 years, wasn't just interest. It was largely price appreciation because money was flowing into safe Thai bonds. So, seen as a decent temporary holding place.
Any forward-looking predictions? Share buybacks, maybe?
Yeah, they speculated that many of the large liquid companies that pass their screens might announce share buybacks, given their likely strong balance sheets. CBS and Centel were mentioned as possibilities, although Centel didn't pass their investment filter.
Interesting. They also clarified CPN's business model.
Right. Emphasized that CPN makes money primarily from renting space in their malls, the rental fees. It's not directly tied to how much tourists spend in those malls, so less vulnerable to tourism fluctuations compared to, say, hotels.
Makes sense. What about the U.S. market overall?
They expressed belief in its long-term future, but found current valuations very expensive. Used a Thai phrase that basically means buying at the absolute peak, like buying gifts on New Year's Day when prices are highest. They drew a parallel to Warren Buffett holding lots of cash right now.
Got it. Any other specific stock mentioned?
A few quick ones. BEM, affected by government intervention on electricity rates, apparently. GRAPH was seen as interesting. It's a holding company with diverse assets. Power, telecom, plus that stake in K-Bank.
Oh, okay.
They urged caution on highly valued stocks like master and beauty clinics, comparing them to finance companies whose high PE ratios crashed when competition heated up. Ochoju, the organic food brand, strong sales now, but questions about long-term trends and affordability in a slowing, aging economy.
Quick hits.
TU, potentially interesting below 10 baht for dividends. Tata's recent rise linked to oil, not fundamentals. AOT believed tourists will return, but valuation isn't cheap by their method now. Oh, and they recounted an old rumor about GREH wanting to take over K-Bank, which led GREPH to sell shares back then, but the source sort of winkingly said they secretly believe GRAPH is still interested long-term.
Okay. And on BH long-term?
Positive view. Aging society drives healthcare demand. Saw the price below 150 baht as a potential entry, even willing to buy more if it dropped towards 100. And they circled back on the book value point, especially for land held long-term. Book value uses historical cost. It doesn't reflect current market value, which can make PBV look artificially low for companies with valuable old land assets, like CPN.
Right. Reinforces that point. Anything on accessing foreign stock?
Or ROE levels. Briefly, yeah. DRs, depository receipts, are good for smaller bets on foreign stocks. Direct buying for those okay with more risk, very risk-averse, stick to bond funds or local funds. And finally, they clarified that an ROE between 7% and 10%, which might sound low to some, is actually considered quite good, quite high by their standards in the current context.
Okay, great summary of the Q&A stuff. So let's try to wrap this up. We've journeyed from that complex global picture, trade wars, distrust through Thailand's specific challenges, touched on that really interesting sovereign debt angle with Japan, and then really drilled down into this specific three-step process the source uses to sift through Thai stocks looking for potential value.
Yeah, and the key takeaway from the process seems to be, first, confirm recent profitability, then check for competitive strength through stable margins. Only then do you look at valuation. Find the strong companies first, then see if they're cheap due to market fear.
Right. And that valuation step, comparing PBV to ROE against the company's own history, that's their way of trying to spot a potential margin of safety. Identifying when the price might be lagging the company's fundamental ability to generate profit.
Exactly. It's a systematic approach, not based on gut feeling or just chasing falling prices. And again, the source stressed this isn't about predicting the bottom or promising quick riches. It's about understanding a framework, one method for evaluating potentially quality companies when uncertainty makes prices attractive.
So thinking about everything we've covered from this source, what really stands out to you personally from this deep dive?
For me, it's probably that connection between the macro war of distrust narrative and the micro level search for resilient companies with stable margins. It links the big picture to specific business characteristics. And here's maybe a final thought for you, the listener, to chew on. If this source is onto something about global trust eroding, how does that fundamental shift potentially change how you view risk and opportunity across all asset classes long term? Beyond just stocks, think currencies, international bonds, maybe even physical assets. Does that distrust factor change the game? Something to ponder.